So it's October 19. We're finishing up chapters 8 and 10 with the quiz coming up tomorrow. So we'll be going through any homework desired. I'm going to comment on that in a couple of minutes. Two other questions on the table. One is the next exam. The next exam, although originally posted October 30, I believe, is probably going to be delayed 1 to 2 weeks. And it will be a take home like you had before. It also will be videoed and we get to watch you. I do want to warn you, there were some red marks on when I reviewed the exam results. And I'm not accusing anybody of anything, but I just want to warn you that we want to make sure that you're not doing what you're not supposed to do, and you know what you're not supposed to do. So I shouldn't have to go down that path. But Respondus does red, green, yellow flags, and there were a couple of reds on there that I reviewed, and a little bit marginal, but again, I'm not accusing, but I want to make sure you're aware and want you to be careful about that. Because I don't want to give you a 0, because that's what ends up happening on a confirmed cheat. So that's not going to be where we want to go. The other question, as I said, on the upcoming exam, it'll be similar format, 50, 51, 52 questions on Respondus, delayed 1 week to 2, but we're going to include a little bit of the managerial stuff, 14 and 15 chapters, because I want to make sure that, and you're not going to have the exam before the quiz is passed. So you'll have the homework, you'll have the quizzes done, and then we'll have the exam after that. But I wanted to ramp up and get the introductory managerial accounting stuff is not just fairly basic. So I want to get through that and include that in the next exam, because the final exam is going to be heavily weighted on the managerial and then a review of all the other stuff. So we'll have a pretty decent outline of what the content will be when we get there. The other question that's arising is the project. I've been stalling posting the project because I want to wait till you get through all the financial stuff. We'll get next week is cash flow statements, and then I'll be posting the projects. And what the project's going to start out as, you're going to do pretty heavy duty financial analysis, horizontal, vertical, ratio, with all the terminology you know. I didn't want to put it 4 weeks ago, 5 weeks ago, because a lot of the terms you didn't know yet. But once you get the cash flow statement under your belt, once you have all the ratios, all the terms, I want to then we're going to do a couple of ratios, and then you're going to compare and contrast. You're going to end up picking a company and or industry that you have an interest in. It could be the company you work for now. It could be another company or industry you're considering. It could be if somebody in the family's in the business and you want to do a deeper dive, or you're thinking about investing in that industry or in companies. And you're going to be looking at least 2 companies, doing the number crunching, the reviews, comparing and contrasting, and ultimately coming up with a conclusion. Who's the stronger? And would I invest or work for the stronger of the companies? And you might say, strong company, I don't want to move to Kalamazoo, Michigan. Or you might say they're strong. Yep, I'm looking at them. It might be worth considering. Or I'm already working here and I'm pretty happy, or I'm already here and I'm surprised at some of the numbers. And this gives me fodder to have a conversation with managers or anybody else. And it's getting me to think how I can make a difference here and help out. You will be reading, as I said, the 10K cover to cover, have at least one of those, most likely both. And you'll be selecting some footnotes of interest based on content we've covered so far in class. So you might look at some accelerated depreciation or LIFO, FIFO inventory, or you look at allowance for doubtful accounts and saying, oh, they were 2.5%, 3%. Now they're at 4%. Something's going on. They're not collecting, or maybe whatever. You're going to be doing that analysis because, again, I've been waiting so that you can understand most of the terminology and have a fairly decent comfort level on the content of where we're going and what we're doing, so that when you review that stuff, it's not Greek. I don't know, it may feel like Greek still, some of it. And I think you're internalizing possibly more than you realize. I think you've come a long way, and hopefully you agree that you've come a long way. So, any questions on what I just discussed, what we just spoke about?
I'm thinking I heard you say, well, there'll be like a template that we'll be following as to what you're looking for.
Yep,
correct?
I will be putting up a Google Sheet, and I'll be demonstrating how to access, again, Edgar and do that deeper dive. But again, you want to be comfortable with Excel. I've had students in the past looking at Excel spreadsheet and taking out their calculator and crunching numbers. I'm saying, why? You know, the chances of making an error just tripled. I mean, you can take a number, divide by this other number, and now you got a number, and you got the ratio or the trend. A common error that's made is when someone writes the formula for an average. They take this cell plus this cell divided by 2, and they don't use parentheses. So what happens is you're about 50% higher. You know, you have 10,000 and 12,000. Take an average and end up with 18,000. Excuse me? Is that even logical? Does that even make any sense? So a lot of when you work on these things, there is logic. There is ballpark math that says, well, it's got to be between 10 and 12. Great, I got an average of 11 something. Cool, I'm good. But if it comes out at 18, you know you're off base. And those are the errors that you should be able to catch as an MBA or as a student or as just a basic logic question as that goes. There was one question I've actually done one-on-one with a couple of folks this past week in the homework. And it was taking a look at your tax rate, which was your taxes paid, okay, based on income, right? Taxes over net income. And with the Jobs Act that came out in 2017, that Trump's Job Act, Tax Act, which where did it cut the corporate rate from? Anybody know?
Is it 21% now?
It's now 21. It was 35.
35.
We were the highest in the civilized world, although I think Britain, UK just raised it from 18 to 25. They were cutting the taxes, but the prime minister there's in trouble, and she's scrambling to appease. She probably won't get bounced, who knows? But anyways, they're raising some rates.
That dude,
Ireland was always the offensive one that had really low rates, corporate rates, which attract a lot of business tax rates. But the tax rates are still at 21 for federal. So you need to combine federal and state. And then the job cut to the JCTA Act that came out. A lot of people were getting the 1 year, like 2017, right? Because that was 0 for the Jobs Act. But 2018 and 2019, you needed to add those taxable amounts to the taxes. And a couple of folks I was talking to were not doing that. So we corrected that. And that's one catch you might have found when you were, if you're consistent with some classmates, you might have said, oh, I got the first one right. These other two didn't pan out. Well, it was because you need to include all the tax obligations with that. And with the Tax Act, a lot of companies, made a bundle, much more income, and a lot of other companies lost a whole bunch more. So it wasn't even. You say, oh, you cut the tax rate, you save a whole bunch of money. But some of those people had deferred tax assets and some had deferred tax liabilities. And what happens is if you used a higher tax rate and you were making calculations and then the tax rate changes, your calculations go to pot and you need to revise those calculations. So for some, it really added to their tax obligation. Some, it really reduced their tax obligation in the financials. Most of them saved on the actual writing of checks, but it actually positively or adversely affected their taxable income at that point based on the adjustments they had to make. So, any particular exercises, problems in 8 or 10 we'd like to go through or talk about? I mean, if not,
Dr. Scott,
go ahead.
one more question about the exam. So are you saying, since you're pushing back the second exam, are you saying you're eliminating a third exam and the third exam will be our final?
Yes, there is no third exam. I mean, if you look at the schedule, I think at the beginning of the year, I had 3 exams posted, but I pulled one of them out. So there are only 2 exams plus 1 final.
Okay, so how does, okay, I guess with the averages would vary a little bit.
Yep, basically the 2 exams become the exam average instead of the 3 exams become the exam average. Because there's a quiz average, there's an exam average, there's a final average, there's discussion averages, and there's final project averages. So it will tweak the numbers a little bit.
All right.
Good questions. Good question. Any particular other exercises, challenges?
Well, now that these figures have changed from what we originally had, what is the target number of points we're looking at these days?
I'll have that out when I have the second exam posted. So,
Okay, it used to be 1,600. Now I'm looking to see what it is now.
yeah, yeah, I will be modifying. I mean, I think it's is it 260 or 230, I think is the exam total. Oh, I'll go
Gotcha.
through that and I
That's
will make, it'll be a clear revision. So you'll clearly understand. Unless you all want a third exam.
Whatever you want to do. I'm just here to get through.
Extra chance to excel. Yeah, I just don't want to double up the exams too close to finals. That was the fear I had. That, yeah, so that's hence the revision. I'm not hearing anything particular, 8 or 10, so let's do a jump into cash flow statements. Because cash flow, as I say, is king and queen. And understanding cash flow and understanding the life cycle of cash flow is kind of important. So let's go ahead and I'm going to go into a whiteboard mode and we'll take a look at our cash flow statement. And we have the three categories that we are intimately familiar with. We have operating, investing, financing. And we have two terms that go with it: sources of funds and uses of funds. Sources of funds are the inflows. Uses are the outflows. Now you can have negative numbers or positive numbers. When we look at our balance sheet, we're going to differentiate current and non-current assets, current liabilities, non-current liabilities, or long-term, whatever you want to call them. When we look at our current assets and current liabilities, that's where operating is calculated from. For investing, this is investing in equipment, investing in other companies. That's where most of the cash flows from investing show up. And then the non-current liabilities like bonds, debt, other forms of debt, and equity are forms of financing. As you know, you either finance with bonds or you finance with equity, selling stock. The two types of analysis that we can do is we can have the direct method or the indirect method. Now, the indirect method is 90+%. And the direct method obviously is less than 10%. So we're going to be focusing on the indirect method for creating a cash flow statement. And a cash flow statement has basically saying, okay, cash came in, cash went out. It's not, I mean, receivables, payables distort the cash picture, right? I made a sale for $100 and I got a receivable for $100. Did that affect my cash flow? No. It will affect my cash flow when that receivable is paid, right? So cash flow is a direct result of actual cash in and cash out. The direct method takes all of those activities and actions and revenues and expenses saying, great, I got it, I spent it. I might subtract receivables or adjust my payables and clear that out. So I just know what my cash adjustments are. So the direct method is a little bit more laborious. The indirect method is actually pretty clean. With the indirect method, we're able to go in and take a change in assets, a change in liabilities, a change in equity, and throw that on the cash flow statement. So let's think about those changes. I'm going to go clear the screen where we're at right now. And let's start with cash flow from operations. Okay. So cash flow from ops. Now, we have a cash balance in our balance sheet, and that beginning cash balance and any cash balance do show up in the cash flow statement. The cash flow statement also typically starts with net income and then gets adjusted for non-cash items like depreciation and amortization. But then you get into cash flow from ops. And you get cash flow from investing. And get cash flow from financing. Now, what happens when we sell inventory? Let's say we sold it for cash. Does cash go up or down?
It should increase if you sold something.
Sold something, increase cash. Okay. How about you buy inventory? Well, in theory, if you're using cash to do it, it's going to decrease cash, right? How about accounts receivable? If we decrease our receivable, that means somebody's paying us. If we increase our receivable, we're financing. Okay. So when inventory goes down, it's a source of funds, increase of cash. When inventory goes up, it's a use of funds. Okay. Up, use. When receivables goes down, okay. So, by the way, I did this backwards tonight. When I sell inventory, when I sell inventory, inventory is down. I mean, it goes down. Is an increase in cash. Now we're right. I just want to get the definition right. When we buy inventory, inventory is up, but it's a decrease of cash. So let's look at accounts receivable. Accounts receivable, how did that receivables decrease? What's the one way accounts receivable is going to decrease? It's going to be reduced. Somebody pays you. So that's an increase in cash. And does our receivable go down or up?
It goes down.
Okay. So the receivable is decrease down, increase in cash. Okay. Source. On the other hand, if we sell something and we don't collect the cash, we're financing the buyer. So when accounts receivable increase, what's going to happen? In theory, we're shortchanging ourselves, which is decrease or a use of cash. So when a current asset is decreasing, it's a source of cash. When a current asset is increasing, it's a use of cash. As opposed to something like accounts payable. How do we reduce accounts payable? Well, we write a check. We pay our bills. Use of cash. And the opposite is accounts payable increases. We're using somebody else's money, our vendor's money, to finance what we're doing. So that is a source of cash. So the indirect method goes through every balance sheet item except for cash and says, oh, did our current asset go up or down, or any asset go up or down? If we're an investment, if we are buying a piece of equipment, our equipment's going up and our cash is going down in theory. That's the way to visualize it. On the other hand, if we issue a bond or a 90-day note, we have an increase in liabilities, but we get an increase in cash, however much the note that we get the cash for. Eventually, we pay off that note, the note will decrease and so will our cash when we pay it back. So assets and liabilities are opposite. A source of funds is when an asset goes down. We sell a piece of equipment, we don't buy it. We reduce our receivables, we sell our inventory. Those are going down, it's an increase in cash on the indirect method. But a liability, when a liability increases, we're increasing our cash flow too. We get a loan, we get more cash, even if it's a loan to buy equipment or such. So the visualization is seeing the indirect method by visualizing the changes in each of those categories. So I'm going to go into Edgar and we're going to actually take a look at a cash flow statement in a minute. But I want to make sure you kind of have a handle and understanding of that. Because the last thing I want to talk about is product life cycle. And you've seen this before. There's the introductory phase, and this is from a marketing perspective. And you got the early adapters, and then it kind of peaks out and falls off. Well, you have the same challenge with that. You have the same challenge when you have operating, investing, and financing. So what happens with operating? And let's say we'll start with negative or positive. In the beginning, we're losing money. So our operations are negative because we're paying our wages, we're buying materials, we're assembling stuff. But eventually that turns positive. Okay? So in theory, and then there'll be some adjustments and eventually it wanes again. Our investing is also starts off negative because we're buying stuff. So if we're investing stuff, we also start off negative and we can be buying for a long time. And then we sell off some stuff or use some stuff up. So we're lots of negative going on. When we get to financing though, that's our either bonds or issuing debt or selling stocks and getting equity. You got positive cash flow and eventually dividends come out of financing too. Eventually, we may have a couple of other issues, but eventually we're falling off. So we're financing the business. We're buying stuff to invest in. And our operations eventually will show positive cash flow based on the operating of the business. If you've heard about real estate investors always monitor the cash flow. They almost don't care what they pay for a property, and they almost don't care about the property itself saying, well, I got a 15-year, 30-year, that's not the question. Question is, does it cash flow? If I'm assuming 90% occupancy, will this building pay all the bills, all the expenses, all the taxes, all the mortgages, anything else that goes with that? If it will pay that, if it's a positive cash flow, great, we're buying a building. A minimum hurdle. If it's a negative cash flow, I don't want to drain. And you say, well, it'll drain you for 15 years, but then the building's paid off for 30 years. That's not the dream of a real estate investor. It's all about the cash flow. So that's where we're looking at the operating, investing, and financing flows. So I said I wanted to go through and take a look at the Edgar to go with that. So let's do that now and get over to. Okay, so I'm going to go in and we're going to take a look at a cash flow statement. Cash flow can get kind of confusing sometimes. So let's go in and so you should all be seeing my Google search. And I'm going to go to Edgar.
I don't see anything, sir.
You don't see anything. Okay, let's try that again then. Thank you for letting me know. New share. Is that better?
Yes, sir.
I typed in Edgar here on the Google search.
Yeah, it popped up now.
Okay, thank you. All right, so search and access. And then we're gonna go over to company or fund name. I can do company filings, company or fund name. And we'll pick a good local company. Like, oh, okay, what I usually like to do, I say ticker symbol. Let's go ticker symbol for Sunoco. There we go. SON. So I'm gonna go back to Edgar and I'm gonna type in SON in the filings, name, ticker symbol, or a industry ID. So we said Sun, which is Sunoco, that first one, which has a SON. Click on Sunoco. The one trick that you really want to make sure you're doing is in the upper right-hand corner, clicking on classic version, because I don't want to read the 10K and have to manually transcribe numbers and do all this wonderful calculation stuff. So I'm going to go in the classic version, which has this interactive data, which is really powerful. And I've got 8Ks and 10Qs and 11Ks and uploads and SDs and all that good stuff. I want a filing type of a 10K. So I type in 10K, I hit return, and it says nada, because it needs a 10-K. The syntax is kind of important. So if you typed in 10K, you wouldn't get much. When I type in 10K, I get all the documents as well as the interactive data. If I go to documents, I can actually pull the 10K from here. I go to my large file here, and I can pull the actual 10K if I want, but I actually don't want to do that. I want to go into interactive data. Interactive data will take you to all the financial statements, and you can see them on screen very gracefully. But I don't want to see them on screen. I want the numbers already there for me in Excel. So I'm going to click View Excel Document. It's downloading my Excel. I'm going to open up the document, and then I'm going to see a bunch of tabs. Hopefully, once the Excel document opens. And when I get there, there we go. So there is my cover sheet, Sunoco, December 31, 21, 10K, annual report, true. I'm going to enable editing here because I'm going to be doing some number crunching in a little while. And when I go through the statements, you've seen this before. You say, okay, audit information. Oh, PwC is the auditor out of Charlotte. Cool. Consolidated balance sheet. Yep, I start with current assets. I got 2 years of data. I've got inventories, finished and work in process. I got raw materials and supplies. I got prepaids, total current assets, PP&E. Notice my equipment here went up. 1,244,000, it's a net, 1,297,000. So I had about 10,000, so about $50 million increase in my equipment. What does that mean? I had a use of funds of $50 million. My receivables also went up. So I'm financing somebody else from 658 million to 755, so almost $100 million increase in receivables. If they decreased 100 million, I know that somebody paid their bills, but they're increasing 100 million. As a matter of fact, a whole bunch of things increased here too. Inventory went up. So we're gonna have a bunch of useless funds, I'm guessing. We'll see on the operating side. Let's take a look at the consolidated balance sheet, parenthetical. This is something about number of shares issued, outstanding. I'm not going to worry too much about that. Other than we have authorized these shares, but we only issued, we authorized 300 million. And we have 100 million, and these are in shares, not dollars. Those are dollars. So we still have 200 million. I mean, 100 million represents 100% ownership. 93 million, right? 97 million represents 100% ownership. issued and outstanding. We looks like we reclaimed some too, to the tune of 3 million, just over 3 million. All right, so let's go on to the next tab. That next tab is income statement. And looking here, yep, sales jumped a little bit. They went down 2020, up 21. Cost of sales, cost of goods sold also dipped and rose, to be expected. Gross profit, yeah, we're a little bit ahead of the game. SG&A, we got expenses, they dipped in 2020 again, probably COVID related, but they went back up. But if I look at the bottom line, I go to the basic earnings per share. Or that's common shares. Earnings per share, 86 cents, basic loss. Last year was 206, the year before 290. What do you mean? We had an 82, and this is an add 6 zeros. I'm sorry, add 3 zeros. So $82 million, $82.7 million loss. In the prior year, we had a $207 million profit. And the year before that, it was a $292 million profit. What the heck's going on? We are losing buku bucks. So I would expect you to be able to go down here and say, okay, that's probably kind of comparable. That's kind of comparable. There we go. There we go. Oh, we have restructuring. So we have less expenses on our restructuring charges. And there we go. But we got a whole bunch more. Okay, so we have more operating profit. So that's looking pretty good. And then I get down to this line item. Non-operating pension costs. Over $500 million. No wonder I went from 207 million down to negative 85 million, even though I'm doing better in sales and profits, operating profit. So we were at 30 million prior year. Now we're at 568 million. Something's going on with pension costs, and we would read the notes to find out why. But you might say, well, based on the operating profit, they're doing pretty well. This looks like a one-time adjustment. Okay, interest expenses down. Reduction in debt maybe. Their interest income is up. They have loss from early extinguishment of debt. They retired a bunch of debt, which is why their interest expense is down, I suspect. So these financials tell a story. Now here we have comprehensive income, foreign currency translation, derivatives, all the kind of funky stuff. But I want to jump over to, okay, so we have an equity, change in equity. Yep, we can watch that too. Yeah, but here's my cash flow. I've got a cash flow statement from operating activities. Notice it starts with net income. First line of defense. Where's our income? Then we have adjustments. You say, wait a minute, I've got an impairment adjustment. These are some gains. I have a depreciation, depletion, and amortization adjustment. Why am I adding depreciation expense that was probably on my income statement back? Well, it's because depreciation was a non-cash item. I added depreciation to my income statement, increase the expense, reduce net income. I need to add back that depreciation to increase my net income because for cash flow purposes, anything that's non-cash, I'm going to be readjusting gains and losses. I have a gain. Nope, no, I don't have a gain. But I have a loss from early extinguishment of debt. I have a loss that's positive. Okay, so I'm adding that back. I deducted my losses on my income statement. I added my gains. I'm going to reduce the gains on my cash flow statement. And I have cash dividends from on and on. Okay. So then I get, so those are my adjustments that are non-cash items. But now I get to receivables, I get to inventory, I get to payables, prepaids, income taxes, accrued expenses, and cash provided by operations. So these are all operating amounts. So if I look at receivables, by looking at that, would you guess receivables increased or decreased? Any takers? It's a use of funds. Okay, because that's a negative number. Did my receivables increase or did they decrease? Well, we had said if a receivable is decreasing, that means someone's paying their bill. That's a source of funds. But because our receivables must be increasing, we're using funds. Let's go back to our balance sheet and see if that's the case. I'm gonna go back to our balance sheet and look at receivables. So I look at my receivables. And sure enough, my receivables went from 658 to 755. And other receivables dropped a little bit, but not nearly to the scope. So sure enough, my receivables are increasing, which means I'm financing my customers. And when they pay me, my receivables will go down. But until they do, that is a use of funds. So here's our statement of cash flow. Our net cash provided by operating activities, though, is positive. So we got hits and cash provided by operating activities, totaling the stuff up here and the stuff over here. We get 298, that's in thousands, so it's 298 million. Where previous year was 705 million. By the way, pension and post-retirement expense, that expense is a non-cash item. Because all of the adjustments are going to happen in the assets, liabilities, and equity accounts in the indirect method. So we're adjusting our net income and we'll have to add that. And that's why we have positive. Now notice our cash flow from financing activities. I'm sorry, investing activities. Here's our net cash used in investing. So when we're buying equipment, PP&E, we must have bought a bunch of equipment, which we did. Cost of acquisitions, proceeds from sale of business, net proceeds from sale of assets. So we sold some assets, we got some cash in essence. So that's a source of funds. And then we get down to financing. And we paid off a bunch of debt, $172 million worth. I'm sorry, I take that back. Proceeds from the issuance of debt. We issued debt, but then we repaid debt. We bought back, we reduced our cash and reduced the bonds payable or whatever debt structure that was there to the tune of 628 million. We bought back a whole bunch of it. Cash is down, debt is down. Commercial paper borrowings, we get some positive cash flow. Outstanding checks, cash dividends. Okay, so dividends show up here as well. Interest expense is usually operating, but dividends show up in financing. Then we have a non-cash line item. And then interest paid, net of amount capitalized, and income taxes paid, net of refunds. So that's what's showing up on our cash flow statement. Okay. So that is what the cash flow looks like. And we're doing this by changes of balance sheet items. That's what the indirect method is all about. Any questions on that? Could I have been that good?
Well, my only favorite question is, will I be able to utilize Excel?
That's a great question. If you are having trouble with Excel, I mean, okay, so you have the instructions in the syllabus how to download Excel if you don't have it already. I'm surprised how many folks still don't have it. That's okay, it happens. But using Excel, that benandboz.com is kind of a great resource for practice. But by this point, you probably should be getting pretty good, at least with basic formulas, manipulating, adding columns, inserting numbers, making calculations, understanding absolute referencing and relative referencing and copying things. So all those you should be reasonably comfortable with at this point. If you want a refresher, I'm happy to sit down with anybody that wants to talk about Excel. But also, I'd ask you to take the Ben and Boz videos first. They'll do 15 to 30 minute segments, and 6 or 8 of them would be time well spent to reinforce. If you haven't used Excel for a while and you're getting back into it, some good reminders, some good shortcut keys. And what's nice about the examples they use in Excel, they're all financial accounting based. They're gonna use balance sheets and income statements. They're gonna use debt repayment, depreciation, LIFO, FIFO inventory, whatever it might be, they're using accounting concepts in their Excel examinations. So that's, hopefully, you'll be comfortable enough with Excel. And it's just so much more graceful being able to use Excel than having to whip out the calculator, start punching the numbers and being on your way. Their comment. Anything else? I'm gonna stop the recording, and then if there are any other comments you need or want to make.